Hello. Yes. So today we are gonna talk about trading models, more like market models in this video. I'll be covering from the basic of how the market moves to the most complex of ways. There'll be four or I guess five of trading models which I'll be explaining in this video. So stick by in the till the end to and please do not skip because I mention just a lot of points uh, throughout this video. Let's start with the beginning. Now we know the market moves like this upwards, okay, or the market moves like this, that is downwards. Now, how do you even catch trades like these? It's simple. To use this trading model, we have to just use a Fibonacci retracement. Place the start placing from the bottom and till the top and just drag to the right and we'll wait for either 50% retracement, more like always wait for 61.8 and 70.5. These are the two zones, 50 to 70.5%. These are three zones which the market touches 80% of the time. If you're just talking about 61.8 to 70%, the market touches this around 60% of the time. And just 70.5, the market touches this for like 40 or 30% of the times. So the best zone is around 61.8, and pairing this with an FVG OB works the best. Okay. If not, then 50% it does. And you take in profits at minus 50%. Now, where do you put your stop loss? Exactly below 88.6%. And for Forex or metals, if your broker does has some spread and slippage issues, you add in the spread accordingly. Now, in bullish, this was for bullish. Now, in bearish, you do the exact opposite. Start from the high to the low and wait for retracement around the same levels. Okay. And take in profits at the 50%. And you can re enter with the same concept and take in profits. It's that simple. Now, this is the most ideal of situation, and we want to make the most money out of the market. The main motive of why we are even here is to make money and not really gather knowledge. Like, what are you even gonna do of all this knowledge if we are not making money? So, the whole point is to make the most amount of money, and we can't really make the most amount of money with this. For that, there's certain patterns in the market also quite common, named as double top, double bottom, okay, head and shoulders. We are gonna cover all of them, but in a smart money concept way. I call both of these, I claim the uh, ideas of these patterns. I have learned this observing the markets for the past 3 months, and my win rate for these patterns, all three of these, is 80%. I'll show both bearish and bullish patterns or models for this. Let's begin. This is my two leg model. Basically, what happens is in a bearish situation, the price moves forward. Okay, it takes out, let's say, a high time frame or a low time frame. does not really matter. It just takes out some liquidity. All right, it takes out some liquidity. Now, what you can do is you can be a high risk taker. Though this is the point, okay? You're you can go for high risk and you can get high rewards, essentially, not essentially. But the thing is, your win rate may drop, but it is certain that you will never miss a market movement. You can just you can place stop loss above the HTF or LTF liquidity area, and the market will sweep and it may go down. Okay, now, this may happen and the market may just keep pushing down. This may happen sometimes, and I call this liquidity sweep. But most often of the times, around 60 to 70% of the times, what market does is it will take out some some confluence area, some liquidity area. It's gonna move down, okay? Probably fill just some OBs, okay? Like most likely some movies, but then it's gonna move up again. Now, where what do you do exactly in this moment? It's simple. Uh, Hold up. Just take the Fibonacci retracement, touch the high and the low, and you will find a definitive low using uh this exact indicator. You have to apply this indicator fractals. Okay, you will find this using this. Just search for fractals by Rachel T. Okay, it will show you absolute highs or high or lows. Okay, now you wait for that to form. Okay, it will tell you that this is absolute low and this is absolute high, and you join the two, and you wait for you wait for the price to bounce. Okay, and reject from the golden area, that is 50 to 878.6. The price may get somewhere in here. It is the best if you couple this with FVG. If you don't find any FVGs, just use the 61.8 or 50%. Okay, just place your entry in here. Okay, 50%. Have a break even at have a add on um or DCA, not break even, my bad. Have a DC at 61.8 or 70% accordingly. If there's no FEGs or OBs in here, okay. And have your stop losses above the high plus spread and slippage according to your broker. Well, for the take profit, it will not essentially be at 0.50%. This is where it gets complex, okay. Now, when the market was moving like this, right? I have to erase this line. Now, when the market was moving like this, it did not just go like that. It did take breaks like these before moving forward and ending its lean over there, right? Now, that's the exact game. You have to place your take profit levels below a internal liquidity. You always target an internal liquidity. For this case, it is a side sell liquidity zone. Now, in most of the cases, the market does take out the side sell liquidity zone and and moves forward and takes out the last high. It will take out the last high. It may not go so further. It may not go so up. It can just go till here. Okay, it's not gonna go up. It just something which the market at that moment decides. Okay, you have to watch out for dollar as well. Okay, it may just take out this liquidity and will continue downwards. Okay, this can happen. Okay, three leg structure. Okay, three leg structure, or the market may move down or the market may move up. Now, what do you actually do? Okay, how do you even determine if the market's gonna go up or down? For that, you have to just take the risk of the probability, man. You have to take the risk. Now, if you see that the market has taken out this liquidity, okay, and it is maybe forming a divergence, okay, it's forming a U, okay, a U down, and the market reclaims this high area, okay, you can just enter in here a short with your stops above this high, okay. Elsewise, uh if that does not happen, do not enter into any positions over here. Okay, at least I don't. But wait, what happened? I'm missing out something here and here. Exactly. You have to take the risk and long in here. Now, there's three, four stuffs when coming, which comes into inversing your position. Like you were in short. You were in short. That's a good point. Now, why are you gonna go further and risk that short position and just long it? For that, you don't close your short. In this model, you don't close your short. Okay, I'm just talking about bearish scenario. I'll just inverse the chart and show you all the bullish scenario when I'm done with this. Okay, I am a bear. Okay, so I find comfort teaching all the shorting position. Anyways, going back to the topic, you don't close your short. Okay, you let your short run. Okay, you just let it run. Okay, till wherever it goes, and you take a long when an internal liquidity is swept. Okay, now what exactly are you gonna do? Okay, you have now two positions open side by side. Okay, you're gonna close the long if you find that there is another U. Okay, another U in here. Okay, or maybe a step down, something like this. Okay, something like this structure, a low and a higher low. Okay, and you see that there's still bullishness and bearishness in dollar. I'm talking about uh euro. Okay, and please, oh god, I forgot, please note that this models, whatever which I'll be teaching, works the best on euro and euro only. Does not works on uh GBP, okay, or Canadian dollars or JPY. It just does not. It sometimes do work on gold, sometimes it does not. But this model is an absolute blaster for scalping in euro, especially in Indian time, 1:20 or 30 to 6 o'clock. Okay, this model especially forms at 4:30 p.m. in Indian time, IST. Okay, uh, the market may either be here in 4:30 or the market may either be here in 4:30, and it will give you an absolute raw. We'll come to the sessions and timings a little down, and maybe in the next video, but not in this one. Now, as we're talking, you wait for this conference. Okay, the market has take out some liquidity, and you see there's sudden bullishness. Okay, in here you open a long. Okay, regardless, this market has swept. There's a low formed. The fractal shows that there's an absolute low form. You take in a long option. Okay, you just start in a long. This is an absolute low. I just place my stop loss below the low. and take into accounts the um the spread, and I mark this. Okay, I mark this high and lower high. Okay, this is what I call as a liquidity trend line. Yeah, this is what I call as a liquidity trend line. Now, what I believe is there's liquidity all over here in the market. So that's exactly my long ideas. Okay, and sometimes there can be an untapped OB in here. Okay, the market just rejected from the Fib and it did not tap into OB. In this case, please guys remember, in this case, at least till this short, Fibonacci is more powerful than OB. Okay, Fibonacci and FVG is more, you know, of confluence until here in this short area than OB. Okay, the market may return back and take out the OB, and it may form a divergence and then continue further down. Now, when exactly it may not go further down is that there's more liquidity upside, okay, or more liquidity downside in the dollar, okay. But if that is not the case, then the market will just continue down after taking these. I want to show you all the uh, exact thing which happens every day on Euro USD. I want to show you all on chart. See, this model, the model which I showed, it's not exactly that. It is not. I'll try finding it again. Okay. It is somewhere in here, but I want to show you all in here first. Okay. See, the market formed a low. Okay. This is from where we'll start. Okay. And see, this is the fractal which says this is a low and this is a high. Now, the market first rejected from the 50%. There is an OB and that OB is already taken. Okay. So I just should have had entered shorts in here. Okay. My stop loss just above here. My uh my take profits. See, there's side sell liquidity over here. So just got a 1 RR or 1.3 RR trade. Okay, after the spread. Now, when when the side sell liquidity was taken, when the side sell liquidity was taken, I denote that sweep. Yeah, yeah, that's sweep. The market took a bullish momentum. Okay, it went up. I saw that there was a reclaim in the range, and I did go for long. Now, what did I do exactly over here? What should I have at least done? Okay, in the next, after this long, I saw that the market went drawn from this high, okay, internal high to internal low. The market has rejected several of the times from the golden zone. And that's a good enough point to just close your shorts. Okay, if the market is continuously just rugging down the golden zone, okay, down or up the golden zone, you just have to close your shorts, okay. So I just open a short position, okay, uh, and take profit below this last low and see how wonderfully that works out. Yeah, and this is how the market moves. In the next video, I'll be talking in a deeper way about this model. This was the basics of my model, and there's a lot more uh, models spread all over the chart. and I'll show